Here are 4 companies I think should be on your watch list starting in Q2. Now that Q1 is officially over, yes, some of these companies have performed quite well, some of them not that much. That's why they're on the list. I think in the coming weeks, you'll get some opportunities to buy them maybe at a cheaper price. A month from now, new earnings season starts, so you'll get even more information from all of those companies. First up, we're going to talk about Dell Technology, and the best intro for Dell comes from, well, the best salesman on the planet right now, Mr. Jensen Huang.
Dell, century right here in our booth here. Dell
offers more end-to-end computing technologies for the world's enterprise than any company in the world. If you need anything in IT, anything in computing and enterprise, you know exactly who to call. You call Dell.
So Dell year to date is already up close to 50%. Yes, if you look at the current valuation compared to its 5-year mean, you can conclude that Dell stock is currently more expensive than you would like it to be. But then if you look at the price earnings to growth ratio, we're at 1.39, which has come down actually since the start of the year. Why is that? Well, because this company is going to have an acceleration in growth, top and bottom line. They have huge momentum with them. And of course, having that mention from Jensen Huang during that GTC event, not once, but twice, I think is already a pretty good sign. Now, if you don't think that that's enough, fair enough. We're going to have a look at their numbers in just a second as well. If we're looking at the state of the company right now, right? If you look at forward PE, 15.1 times, EV to sales of just 1.1 times. And then if you look at the analyst estimates for the coming years, some single-digit growth, mid-single-digit growth for sales year over year. Then with EPS, you'll get next fiscal year 14% year-over-year growth and then another 10.4% in fiscal year 2027. For fiscal year 2025, you'll just have to be happy with 6.10% year-over-year growth with regards to EPS. Of course, these numbers will probably change in the coming quarters. Now, why do I think this year and the coming years will be good for a company like Dell? Well, first of all, if we'll go back to the Q4 report, you can see that net revenue was down 11% for the quarter. For the year 24-23, it's down 14%. I think we're getting into the area where the comparison, year-over-year comparisons are going to look pretty good for a company like Dell, who is going to experience some tailwinds. Now, that said, right now we can clearly see that profitability side of the business has been improving quite a lot. Operating income was up 25%, net income 91% year over year, earnings per share diluted up 89% year over year. But then for the rest here, adjusted free cash flow down 55%, non-GAAP net income up 22%, non-GAAP operating income down 1% from the same quarter last year. Now that said, if you look at the full year cash flow from operations, that reached now $8.7 billion. They also announced a 20% increase in annual cash dividend to $1.78 per common share. There's even more positive news. Well, it's negative, but positive news for the stock. So Dell will reduce headcount as cost-cutting measures continue throughout fiscal year 2024. A report came out that said that the global PC monitor market returned to growth in Q4 2023. IDC anticipates a steady recovery in shipment volume through 2025, with commercial growth outpacing the consumer side in 2024 and 2025. New models with higher refresh rates, falling prices of bigger screen size models, and continued growth in gaming are some of the factors driving the recovery, and of course Dell being a player in those markets. Then moving to AI PCs, those are set to grow share in global PC shipments, starting major market transition. This is something I've been talking about for quite a while now, not just it, but also a Windows 12 refresh cycle, probably going to start second half of this year. So in 2024, about 18% of total personal computer shipments globally will be AI-capable PCs, and this would only be the start of a major market transition. The firm predicts that an estimated 48 million AI-capable PCs will be shipped worldwide this year, and the number is expected to exceed 100 million, representing 40% of all PCs in 2025. In the short term, analysts expect a 10% to 15% price premium on AI-capable PCs versus PCs with NPU integration. In 2028, the firm expects vendors to ship 205 million AI-capable PCs, representing a compound annual growth rate of 44% between 2024 and 2028. So that's already one of the tailwinds that will drive, in my opinion, that will drive Dell stock up because, well, the stock will follow what revenues and income earnings represent. Second part is this. So they told us last earnings call, they shipped $800 million of AI optimized servers and our backlog nearly doubled sequentially, exiting the fiscal year at $2.9 billion. Demand continues to outpace GPU supply. Though we are seeing H100 lead times improving, we're also seeing strong interest in orders for AI optimized servers equipped with the next generation of AI GPUs, including NVIDIA's H100s and let's say the equivalent from AMD. Now, before moving into stock number 2, if you enjoy this type of videos, leave it a thumbs up, subscribe if not, we really appreciate that. Want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, stock number 2 is a stock that really is doing everything right, but the stock itself is not really moving that much, and that's Sofi Technologies. Of course, we've talked about Sofi Technologies quite a lot on this channel for many months, actually since the SPAC days. Right now, year to date, it's down 26.63%. One share will cost you $7.30. Of course, if we look here at valuation, the forward PE of 162 times, to me, it just doesn't make any sense to be looking at forward PE right now for this company. What you can see here is what the analysts are expecting the company to report top and bottom line for the coming fiscal years. Huge growth bottom line for the next couple of fiscal years, and then sales growth of around, let's say, 16 to 20% for fiscal year 24, 25, and 26. Now, looking at what management is expecting for fiscal year 2024 and beyond. So I'll first start with the beyond part. So beyond 2024, management expects 20 to 25% compound revenue growth for the time periods of 23 to 2026. This implies 50% compound growth for financial services revenue, mid-20% compound growth for the technology platform revenue, and mid-teens compound growth for lending segment revenue. This is expected to drive between 55 and 80 cents in GAAP earnings per share in 2026. Moreover, we see 20 to 25% EPS growth beyond 2026, reflecting both the continued growth of the core business growth plus the added benefit from new business lines launched in the 2024 to 2026 time period. Then looking at next quarter and full year guidance, they expect to generate $555 million at the midpoint of adjusted net revenue, $110 to $120 million of adjusted EBITDA, and GAAP net income of $10 to $20 million. This guide anticipates a 20% adjusted EBITDA margin. For the full year, they expect tech platform and financial services segment combined to grow at least 50% and lending revenue to be 92 to 95% of the 2023 levels, and expenses under EBITDA line to be flat when compared to 2023 results, excluding the reported goodwill impairment expense. Now, of course, with the guide for this year, everybody's talking about rate cuts. How many? When? Will it actually happen? Will it not happen? Will it impact Sofi's guidance, etc., etc.? Well, this is what is already included in their guidance. So they assume a contraction in GDP in 2024, an increase in unemployment to higher than 5%, and broadly a continuation of uncertain new capital market activities and continued normalization of consumer credit. From an interest rate perspective, we are assuming 4 rate cuts in response to a contracting economy, higher unemployment, and deterioration and normalization in credit performance, with Fed funds rate reaching approximately 4.5% by Q4 2024, which in my opinion is a very pessimistic scenario. So to me, this seems like they're putting the bar already quite low. The same happened in 2023. I don't know if you remember, but the guide in 2023 was also quite pessimistic. So, I mean, they are being realistic when looking at 2024. They don't want to guide way too high, only to then be disappointed because the Fed did not cut rates as many times as expected. Unemployment rate is still very low, etc., etc. No, their scenario here is, in my opinion, well, the worst case scenario. So to say that, oh, SoFi is now super low because, well, We don't know how many cuts will happen this year. The economy is doing this and that, and management is not aware of what's going to happen. No, I think management is very, very well aware, and they've proven that for the past, 2 years or so, with triple beats across the board close to each and every time. Then I'd also like to show you that, the short interest right now sits at 23%, which is quite high, and of course puts a lot of pressure on the stock, which means that maybe next earnings report, if it's again a triple beat, guidance is raised, maybe we'll get a small short squeeze. But as we know, the stock goes up after an earnings beat, and then 2-3 days later, the stock is back down to $8-7 or so. Rinse, repeat each and every time until it is broken, until the trend is broken and the market truly looks at that company and says, okay, it should not be valued as a traditional bank because it is not a traditional bank. Let's wait and see. I believe it's in a month or from now we're going to get those new earnings numbers. Up next is a company where I have a very, very tiny position right now. If it works out, I think it's going to be huge. And if it doesn't, then it will have a minor impact in my portfolio. That company might be going to the moon, literally actually, and that's Rocket Lab. Rocket Lab currently has a market cap of just $2 billion. Year to date, it's down 25.68%. One share will cost you just $4.13. Currently, EV to sales in the next 12 months, 4.3 times. If you look at what the analysts are expecting for the next coming fiscal years, sales growth growing quite rapidly, close to 50% for the next 2 fiscal years. Fiscal year 2024, 76.48% year-over-year growth. EPS will only turn positive in 2026. Fiscal year 2026 could happen later, could happen sooner. A lot of its future success, let's say, will be measured on the success of their next rocket, which is Neutron, which is going to be the equivalent of a Falcon 9 from SpaceX. So from the recent earnings report, we got these numbers right here. Fiscal year 2026 revenue increased 15.9% year over year. As for Q4 revenue, that came in at $60 million, that increased just 11.3% year over year. Majority of their revenue comes from space systems, and then the second part from launch. But being a bit more forward-looking, you can see that its backlog increased 107.7% year over year. If we look at the profitability trends trailing for months, you can see that gross profit has been improving. They expect gross margin to continue to improve over time due to increased scale, production efficiencies, and product mix. Attaining adjusted EBITDA break-even is dependent on the above factors, as well as the pace of Neutron-related investments. Because remember, right now they're investing a lot in a product that does not generate any revenue. The moment that changes, whenever that will be, I don't know, but the moment that changes, their profitability profile becomes much better. As for the outlook for Q1, they expect revenue to be in the range of $92 to $98 million. GAAP gross margin to be in the range of 24 to 26%, driven by favorable mix between launch and space systems and favorable mix within space systems, and they expect non-GAAP gross margin of 29 to 31%. Of course, this is right now a business that the more launches that they can make, the better it will be from a profitability standpoint. If there are any delays, that's a negative impact on the quarter and probably on the year as well. But to me, valuation at $2 billion, Electron doing quite well for them. They're working quite hard on Neutron. Neutron is really what's going to take this company quite literally maybe to the moon, but the stock, the valuation much, much higher. But Electron right now is already a very, I won't say very profitable business, but it is a profitable business for them. If they can continue to scale that up, have many more launches each and every quarter, each and every year, much better for the business. That's how they increase revenue, and the more launches that they make, the more profitable that those quarters will become. Now the next step, of course, is Neutron, and as I've discussed with Vince during the live stream, services, space services is really going to be huge for this company. To me, this is a bet on their success, and at $2 billion, in my opinion, if it works out, huge success for my portfolio. If it doesn't, a very tiny miss that will not be noticed in years to come. Up next is also a company where there is a small link to space, and that's because of Elon Musk, And yes, I have to put Tesla here. Now, with regards to Tesla, it's because we're going to get the production and delivery numbers, I think, on Tuesday. That might and probably will impact the stock positive or negative, which means you're probably going to get an opportunity in the coming weeks. And then at the end of the month, we have the earnings report, more importantly, the earnings call, where some things might change the sentiment around the company, especially since, well, the last earnings call was horrible. Right now, the company is worth $559.8 billion. Year to date, the stock is down 29.25%. Yes, analysts are expecting fiscal year 2024 to be quite a horrible year, which, fine, we've known this for quite a while. EPS to actually decrease 4.14% year over year, and sales to only increase 11.71%. But then, going into fiscal year 25 and 26, you're seeing a reacceleration top and bottom line. Now, for those that don't know, I do Tesla weekly episodes each Saturday. You get an update on the company, all the numbers, all the news. So I'm not going to bore you by repeating the same thing again and again. That playlist will be in the top right corner. Now, I do want to show you the numbers from last quarter, the production and delivery numbers from last quarter. As you can see, for Q4, they produced approximately 10,000 more vehicles than that they delivered, which could mean that with the downtime that we had this quarter, right, with the refresh Model 3, some downtime in Berlin, etc., they could use the extra vehicles from Q4 and maybe increase the deliveries for this quarter, and might surprise the analysts, that might surprise the people that are expecting way less deliveries than a year ago or a quarter ago, certainly a quarter ago. We also know that Tesla just produced their 6th millionth vehicle, which means that you can calculate approximately what the production was in Q1. And then if you look at the difference here between production and deliveries for last quarter, which was around, I think, 2.2, 2.13% or something like that, if you do the same calculation, you say, okay, maybe for this quarter, they also produced 2.1% more than what they delivered, then you can get a number, I think it's around 418,000 deliveries, which of course is much less than a year ago. But again, these are quarter to quarter things. With Tesla, you have to see years, if not decades ahead. A lot can change with regards to Tesla 3, 4, 5, 10 years in the future. If you're not willing to hold for that long, that's fine. Of course, we all want to enter or add to our positions at better prices. Maybe we're going to get that chance in the coming days, maybe even weeks. Of course, those are just 4 companies, plenty of other great companies right now to pick up. Do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if not, and I'll see you all in the next one. Bye-bye.